Gary Wagner here, just after 10:30 in Honolulu, 4:30 in New York on Monday, the 18th day of November, 2013, and this is the Daily Report for Gold and Silver. What a start of the week. We are under significant pressure in the precious metals markets, trading off almost 2% across the board, 1.90% lower in silver, 2% lower in platinum, 2% plus in palladium, and 1.35% lower in gold. Gold, $12.7230, puts it off about $17 on the day. $69.50 is the low. You can see on the 60-minute chart we are just coming off the low, and the high is $12.8950. And there's no doubt market opens up and drifts lower. Silver also under significant pressure, strong pressure, off about 40 cents on the day, 20.38, the low 20.24, and the high 20.87. Traders, we are looking at a half-a-day candlestick chart, standard candlestick chart. We talked about a couple of candlestick patterns that we saw developing last week. Piercing line being that really gave us an indication that we might see some sort of an upward spike. I was looking for that spike to go anywhere up to about 1300 to 1310. That was our basic forecast. We came well shy of that because, as you can see, 1294.60, it's a 76% retracement. The retracement is of this most recent decline. Your 76% is right here at 1294, and that proved to be really strong or superlative resistance. In terms of a candlestick pattern on the half-a-day chart, we got a dark cloud cover. That's this two-day pattern here, and this last candle here is our confirming candle. It is a signal on a very, very short-term basis that's indicating potentially lower pricing ahead. Now, today's activity is really apparent when we pull up our daily chart, standard candlestick format, of course. And the interesting thing is that as this market last week hit this bottom at around 1260, we got a piercing line. We did get confirmation the following day. One of the reasons that I have been sidelined is that confirmation, as far as I was concerned, was very, very weak in terms of the size of the candle. Then on the following day on our daily chart, the body size even gets smaller. Now, it is still a green candle, meaning it's a higher close, but it was, as far as I was concerned, a very, very meek up day at best. Now, I had thought originally that this market might, on this particular move up, trade as high as around 1300 before falling into resistance. And as we saw before, 1294 was really the point in which it hit really, really strong resistance and began to move down. And all I've really done is converted our standard candlestick into the Japanese average. Japanese average is always going to lag behind, and you can see quite easily it has gone to red. Very small body though, because it's comparing itself to the midpoint of the prior day or prior candle. And especially when I'm looking at defined pivot points, I like to look at candlestick patterns themselves. Now, where are our different support levels in the market? And there's really two ways that we'll want to go look at that and kind of analyze it. Let's go ahead and blow this chart up just a little bit so that we can get a nicer sized candle in there. And when we take a look at our daily chart, this, of course, continuous contract of COMEX trading under substantial pressure. The key levels that we have been looking at, first of all, was about 1275. That was the 61% retracement. Of course, that's a retracement of this last large rally that we're labeling our wave 4, the bear count wave 4. Market comes down, and on this low here, it hits a low of, I believe it was 1250, comes up to a top of just around or above 1335. 1335, of course, we run back into our long-standing resistance, cannot overcome this on a technical basis, and the market begins to trade lower. Now, as it trades lower, it does make a low right in here of approximately 1260. So it's about $10 higher. And as I said last week, I'm expecting some sort of a little bump, a little rise in the market, but I think at best it's going to be short-lived, because in terms of the count that we're looking at, as we talked about on Friday, I currently think that we are in wave 3 of 5, and 5 being our final wave down. To really look at the bigger picture, we'll go ahead and pull up a 3-day chart. Now, with the 3-day chart, we can absolutely take a look at the bigger picture. The way that we're currently labeling is wave 1, wave 2, a tremendously long wave 3. That's the fall from grace, this triple top at 1800 that really never could get taken out. And that, of course, comes after the record top of 19 plus the historical contract and record high of gold prices. We get probably the most substantial rally that we have seen, well, really, if we take a look at it, since maybe April, June of 2012, we get a $200 rise from 1181 up to 1436, and then we run into this real resistance area, this long-standing resistance line. Market comes down, and these are the two lows that we have talked about. So we have 3, I believe we've completed 4, and I think that we are currently in wave 5 of 5. So what are the key levels that we need to watch? Well, the market's obviously broken through the 1276 here. I've got it at 1274. We do have these lows here at 1250 and 1260, and then just below that is 1239. Those are going to be, as far as I'm concerned, the real key levels to watch if this market continues under pressure. Now, with that in mind, we can then take a look at our daily chart so we can look at the current sub count. So I brought back up our daily chart. We talked about this long wave 3. We've talked about wave 4 that I believe was composed of an A, a B, and a C wave. I think that we saw a wave 1, a wave 2, and that we're currently in wave 3. And then again, if in fact that is correct and we are in this third wave, and if we follow the basic tenets of Elliott wave theory, which states that of all of the impulse waves, and in a bear count, bear or bull count, 1, 3, and 5 are always your impulse waves, 2 and 4 being your corrective waves going counter trend. But this wave itself should be at least equal to, in terms of price move itself, to wave 1. And so as we did on Friday, if we simply bring in a scalable line, and that scalable line looks at the range, the price move of wave 1, and we carry that over, that would take wave 3 to the record low. And when I say record low, it's the lowest we have seen gold trade since it hit the record top back at 1900 plus. But this low here, this 1181, has only been tested once, because following that we had the dramatic rise, and on each subsequent fall here as well as here, on each fall we had a higher low, and we never even came close to attempting to see if this particular level long term would hold. It held well above that. So in terms of what I'm looking at right now throughout the week is, we have to see, of course, if it continues lower, how it's going to react at the 1250, 1260 area, because we do have lows there. And then following that, the real target, the real area to watch has got to be 1240. Now, just as with gold, we had a key level that was broken in silver today. We identified this 61% retracement point, 2068, so call it 20 2070, 2075. Market is now well below that, trading at 2039. I really believe right now, once we have reached this, what I thought would be pretty strong support, I think that we can see this market carry itself down to really the next level, which is below this area because it's below $20. I would look at 1967. That is going to be our next real level to see how the market reacts. If it continues lower, will it find support there, or will it trade to these lows right in here, which are just about $18 per ounce. This has been Gary Wagner, wishing you as always good trading. We'll talk to you tomorrow on Tuesday for another daily update review. Bye-bye.